Markets fluctuate, but your investment shouldn't be negatively impacted every time. Welcome to Money Gainers Hub, the channel where smart money moves become simple. We break down personal finance wisdom, including earning, saving, wealth building, and investing into powerful and practical tips, so you can make smarter money moves fast. Grab your notebook, get focused, and let's unlock your next financial breakthrough starting right now. This video will teach you how to create a diversified ETF portfolio equipped to handle any economic challenges. What is the importance of diversification? Diversification is a fundamental principle of effective investing. It mitigates risk by distributing your funds across various asset classes, sectors, and geographic regions. A well-balanced ETF portfolio leads to more stable performance during economic downturns, inflation, bull markets, or global disruptions. Let's explore the proper method to achieve this. What is an economy-resilient investment portfolio? Creating an economy-resilient portfolio doesn't mean avoiding losses entirely. Instead, it focuses on minimizing risk while allowing potential growth. Hence, essential components for creating an economically resilient investment portfolio include component number 1, exposure to global stock markets. Component number 2, inclusion of defensive sectors like healthcare and utilities. Component number 3, bonds or fixed income ETFs for added stability. Component number 4, possibly a touch of gold or commodities. This combination prepares your portfolio for inflation, rising interest rates, recessions, and economic expansion. So what are the core ETFs to incorporate? ETF number 1. If you want to represent the entire U.S. stock market, VTI, Total U.S. Market, or VOO, S&P 500. ETF number 2. If you want to access both developed and emerging markets, VXUS, International ETF. ETF number 3. If you focus on stability and income generation, BND, U.S. Government Bond ETF. These 3 ETFs collectively offer exposure to stocks, global markets, and bonds, empowering a diversified portfolio. However, to safeguard your portfolio during challenging times, consider investing in defensive ETFs such as Defensive ETF number 1, XLV, Healthcare ETF. Healthcare typically remains resilient even during downturns. Defensive ETF number 2, XLU, Utilities ETF. Utilities are essential, maintaining stability in crises. Defensive ETF number 3, SDHD, Dividend ETF. Quality dividend stocks backed by solid financials. These 3 ETFs serve to manage risk amid economic uncertainty. Looking for extra protection against inflation or market downturns? In order to be considered for inclusion, ETF number 1, GLD, Gold ETF. Gold often appreciates when stock values decline. ETF number 2, TIP, Treasury Inflation Protected Securities. These bonds that appreciate alongside inflation. ETF number 3, DBC, Commodities ETF. It provides exposure to oil, gas, metals, and agricultural commodities. These are not necessary, but they are handy assets during turbulent market conditions. Here is an example of a diversified ETF portfolio for a balanced investor. 40% from VTI or VOO to represent U.S. stocks. 20% from VXUS to represent international stocks. 20% from BND to represent bonds for stability. 10% from XLV or SCHD to represent defensive category. 10% from GLD, Gold, or TIP for inflation protection. This portfolio functions effectively across bull and bear markets, inflation cycles, and shifts in interest rates. So, adjust the allocations based on your individual risk appetite. How to sustain the portfolio. After constructing it, remain committed. So follow these steps. Step number 1. Rebalance your portfolio every 6 to 12 months to maintain your goals. Step number 2. Add new investments without disrupting balance. Step number 3. Monitor performance but avoid overreacting. Consistency is crucial, so focus on maintaining your strategy rather than pursuing fleeting returns. What are the common errors to avoid? Error number 1. Overconcentration. Avoid allocating 80% to tech or limiting to U.S. equities. Error number 2. Neglecting bonds. Bonds may seem dull, but they offer crucial protection. Error number 3. Chasing market fads. Avoid basing your portfolio on trends or hype. Error number 4. Omitting global exposure. International growth strengthens your portfolio. Creating a diversified ETF portfolio is straightforward, and it's also wise. It can reduce risks, enhance returns, and contribute to wealth growth in various market conditions. Begin with foundational ETFs, add defensive options and inflation hedges, and rebalance as necessary. If you found this video informative, please like, subscribe, and watch our next video on the best dividend ETFs for sustainable passive income.